Hello, everyone, and welcome back to Synaptic Investing. Hope you're having a fantastic week and are ready for another deep dive. Today, we're breaking down one of the most talked about and maybe misunderstood giants in the tech space, Broadcom. A lot of you have been asking about this one.
It's definitely a complex beast. On the surface, it looks like a semiconductor powerhouse that suddenly pivoted into software. But the real question for us as long-term investors is this. Is this integrated model a truly durable fortress, or are there hidden vulnerabilities the market might be overlooking, especially with that massive VMware deal? That's what we're here to find out.
That's a massive question. And before we get into the weeds, just a quick note for everyone watching.
Yeah, for those who want to actually act on these investing ideas, having a professional-grade platform is really key. We use interactive brokers ourselves, and we've partnered with them to get our viewers a stock bonus when they sign up.
You get a bonus and support the channel at the same time, which is great. That link is down in the description, right?
That's right. And of course, if you find value in this kind of, in-depth discussion, the best way to let us know, and honestly, to make sure you get the next one, is to subscribe and like the video. It genuinely helps the channel grow.
Definitely. And if you have any questions about Broadcom as we go, please manifest yourself in the comment section. We do read them.
Perfect. Okay, let's get into it then. Pillar number 1, the business model.
So, Broadcom, how do we even start to understand this company today? It's changed so much.
Yeah, where do we begin? What is Broadcom's fundamental business now? And maybe more importantly, is it built to last? Does it make sense?
That's absolutely the right place to start. I think the best way to understand Broadcom is through what I call its dual-engine business model. It's something they've very deliberately engineered over the past decade or so, mainly through some really significant strategic acquisitions.
Okay, dual engine, tell me more. So think of it as two powerful, increasingly interconnected revenue streams. On one side, you've got their original foundation, semiconductor solutions. This is where they use a fabless model, meaning they don't own the hugely expensive chip manufacturing plants, the fabs.
Right, they skip that massive capital cost.
Exactly. They pour their energy and capital into the really high-value stuff. The cutting-edge R&D, the complex chip design, building up this huge library of intellectual property. Then they outsource the actual making of the chips to giants like TSMC. It's capital light, gives them flexibility, better returns on capital. You get the idea.
So they're the architects, not the builders. What kind of chips are we talking about?
Critical ones. We're talking high-speed networking silicon, like their Tomahawk and Jericho lines. These are basically the traffic cops inside massive data centers directing all that data flow. Then you've got the RF filters, Wi-Fi, Bluetooth chips that are essential in, every smartphone, plus key components for broadband access, enterprise storage. It's pretty broad.
And who's buying these? Big names.
Oh, yeah. Their customers are the large OEMs, the big tech brands putting these chips into devices, and crucially, the hyperscale cloud providers. Think Google, Meta, Microsoft, the ones building those enormous data centers who absolutely demand the best performance.
Okay, that's engine number 1. What's the second engine?
The second engine is infrastructure software. Now, this side of the business was built almost entirely through acquisitions. Think CA Technologies back in 2018, Symantec's enterprise security arm in 2019, and then the real game changer, VMware, in 2023. The goal here was pretty clear. Build a stable, high-margin, recurring revenue stream to balance out the ups and downs you often see in the semiconductor market.
Right. Semis can be notoriously cyclical. So what kind of software did they buy?
It's core enterprise stuff. Virtualization is the big one, with VMware Cloud Foundation being central. Cloud management tools, cybersecurity, mainframe software from CA Tech. It's the software that runs the guts of large organizations' IT. And that VMware deal, it dramatically shifted the revenue mix. For fiscal 2024, software is expected to be something like 42% of total revenue. That's huge, a massive transformation from just a few years ago.
Wow, nearly half the company now. But are these just two separate businesses bolted together, or is there more to it?
That's the crucial point. It's not just diversification. It's designed to be a symbiotic system, a strategic feedback loop. See, their deep relationships in the semiconductor world with the biggest tech consumers give them incredible insight into future infrastructure needs, what hyperscalers will need 3-5 years down the road.
Ah, so the hardware side informs the software R&D and maybe vice versa.
Precisely. It guides R&D for both hardware and software, especially for demanding stuff like AI infrastructure. And then bringing VMware into the fold puts Broadcom's software right at the heart of the enterprise data center. That's a strategic control point. This reinforces the hardware side because now they can offer this integrated stack, custom silicon, networking gear, and the virtualization software managing it all. That's a really tough offering for competitors, the pure play guys, to match.
Okay, so it's a unified strategy, not just two divisions. That sounds powerful, potentially very durable, but is it simple? Sometimes complexity kills endurance.
That's a fair question. Is it simple and enduring? I think at its core, the model is elegantly simple. Broadcom aims to be the absolute leader in these mission-critical tech niches where performance and reliability are everything. They're selling the essential picks and shovels for the digital economy. And when you look out, say, 10, 20 years, the endurance looks pretty solid. Why? Because it's anchored to these massive, irreversible structural trends.
Okay, what trends are we talking about?
Well, first, the obvious one. The absolute explosion of data. It just keeps growing exponentially. Creation, processing, storage, movement, it's relentless. Think cloud, 5G, IoT, and now the massive wave of AI. Every single one of these demands more powerful, faster networking, storage, compute. That's Broadcom's bread and butter on the semiconductor side. As long as data grows, demand for their core tech should be robust.
Okay, data growth. Makes sense. What else?
Second, the increasing complexity of enterprise IT. Companies are moving to hybrid cloud, multi-cloud, mixing their own data centers with different public clouds. It gets complicated fast, and that makes a standardized, reliable virtualization layer like VMware even more critical. It's like the operating system for the entire enterprise data center, bringing order to potential chaos. That need isn't going away. It's arguably getting stronger.
Bringing order to chaos. Yeah, I can see the value prop there.
Definitely. And third, underpinning all of this is just predictable human behavior, specifically risk aversion in high-stakes environments. If you're building a multi-billion-dollar AI data center or you're a global bank running critical financial systems, you don't pinch pennies on core components.
Failure's too expensive.
Exactly.
Yeah.
Catastrophic. So you choose the best-in-class, most trusted components to minimize risk. You pay a premium for reliability. Broadcom positions itself as that premium, trusted provider in its niches. That plays right into basic risk management.
Okay, essential tech, big trends, risk aversion.
Yeah.
That sounds like a recipe for a strong competitive position, a fortress, as you said. So what exactly protects this business? What's the moat?
It is indeed a formidable fortress, and its economic moat, as analysts like Morningstar confirm with their wide rating, comes from two distinct but, again, complementary sources. First up, you have intangible assets, primarily in the semiconductor business. This is about decades of accumulated expertise in super complex chip design, plus a huge patent portfolio. You just can't replicate this overnight. Think about their high-speed networking Silicon Tomahawk, Jericho, or their custom AI accelerators, these ASICs they build for specific AI tasks, or even sophisticated RF filters for wireless.
These aren't commodity ports.
Not even close. A competitor would need billions of dollars and many, many years of intense R&D to even get close to Broadcom's performance and IP in these areas. It's a massive barrier to entry, a really deep, wide ditch around the castle.
Okay, intangible assets. What's the second source of the moat?
The second source is high switching costs, and this is where the infrastructure software, especially VMware, really shines or perhaps grips. VMware's vSphere hypervisor isn't just popular, it's the de facto standard for server virtualization. It is deeply, deeply embedded in the IT operations of most large enterprises globally. We're not talking about a simple app you can just swap out. This is the foundational layer. Entire application ecosystems, operational processes, even the skills of the IT staff are built around VMware.
So it's woven into the fabric of the organization. You can't just rip it out.
Exactly. Trying to migrate away from VMware for a large enterprise, it's like trying to change the foundation of a skyscraper while people are still working inside. It is monumentally difficult, incredibly expensive, and hugely risky. It means re-architecting infrastructure, retraining potentially thousands of staff, accepting major operational risk during the transition. It can literally take years.
Wow.
This creates what I call Superglue style lock-in. It gives Broadcom tremendous leverage.
That phrase, superglue style lock-in, really paints a picture. Can you give us a concrete example? When did we really see this moat, this lock-in, flex its muscles?
Oh, absolutely. The most dramatic, maybe even brutal example is what Broadcom did immediately after the VMware acquisition closed in November 2023. In a move that shocked many, they just completely terminated VMware's long-standing perpetual license model. Gone. They also got rid of selling products individually, a la carte. Basically, they forced the entire customer base onto new bundled subscription offerings.
Change the rules overnight. just like that.
Pretty much. And this wasn't just a quiet policy change. It came with absolutely staggering price increases for many customers. Reports started flying about costs going up 5 times, 10 times. I saw numbers up to 1,200% in some cases.
1,200%.
Yeah. It got so bad that major players like AT&T actually filed a lawsuit claiming they were facing something like a 1,050% hike in their annual VMware costs. Now, that is a textbook example of a company wielding immense pricing power. And that power only exists because of the moat, because of those incredibly high switching costs.
So customers must have been furious.
Furious is an understatement. People described a visceral, emotional reaction. Formal complaints were filed with EU regulators. There was massive backlash. But Broadcom basically held firm. Management knew that despite the anger, the cost, complexity, and risk of actually leaving VMware were just too high for most large enterprises, at least in the short to medium term.
And the financials back that up.
Absolutely. The software segment's revenue and margins soared after the changes. It was brutal, maybe, but it was undeniable proof of the Moat's strength. It could withstand that level of customer unhappiness.
Wow, that's aggressive. But doesn't that create enormous long-term risk? Pushing customers that hard? Are you just begging them to find an exit, even if it takes years? How does that moat trajectory look? Is it actually widening, or are they potentially damaging it?
That is the critical question, the second-level thinking we absolutely need to dig into, and we will, but purely looking at the current strength and trajectory, the evidence suggests the moat isn't just holding, it's arguably widening. And the main driver, the massive build-out of AI infrastructure.
How so?
Well, building these huge AI models, these elephant workloads, requires connecting tens, maybe hundreds of thousands of GPUs. That needs incredibly fast, low-latency networking, and Broadcom's Tomahawk and Jericho Ethernet switch silicon. They're the gold standard for that. That makes their core tech even more critical to the future of computing. That widens the intangible asset moat.
Okay, so AI demands make their hardware more essential.
Right. And then look at the custom AI chip side. Hyperscalers like Google and Meta want their own specialized AI accelerators, ASICs, to optimize performance and cost. Often instead of just buying standard GPUs, who do they partner with for that complex design work? Increasingly, it's Broadcom. These aren't just sales, they're deep co-engineering partnerships. That embeds Broadcom's IP even deeper, making them a strategic ally in the AI race, further strengthening that intangible asset moat.
And on the software side, VMware.
On the software side, the strategy is to position VMware as the platform for private AI, letting enterprises run AI workloads securely in their own data centers. If successful, that extends VMware's already high switching costs right into the next big wave of enterprise computing. So multiple forces seem to be pushing to widen the moat, at least for now.
It really sounds like several powerful forces are converging here. This reminds me of Charlie Munger's concept, the Lollapalooza effect, right?
Yeah.
Where different factors multiply each other.
Exactly. That's a perfect analogy. It's when the whole becomes far greater than the sum of its parts. Not 2 + 2 = 4, but maybe 2 + 2 = 8, or even 16. And Broadcom looks like a textbook case. You can identify at least 4 key factors interacting here. First, like we said, best-in-class technology. That's the intangible asset moat, dominant IP in critical niches. Second, the embedded customer base, driven by those high switching costs, especially with VMware, the superglue effect.
Okay, tech leadership, sticky customers.
Third, there's scale and acquisition prowess. This proven ability to buy big, mature tech companies and just ruthlessly optimize them for value. And finally, number 4, visionary capital allocation. A management team led by Hock with a clear, disciplined playbook focused entirely on maximizing long-term free cash flow per share.
So these 4 things feed off each other.
Precisely. They create this self-reinforcing flywheel. Tech leadership builds trust, leading customers to standardize on their embedded software. That software generates massive cash flow, which funds the next big acquisition. That acquisition gets optimized by management, generating more cash, and the cycle repeats. Think about the AI data center. Owning the best networking chips, designing the custom AI accelerators that plug into them, and controlling the software virtualization layer that manages it all. That creates this incredible feedback loop of insight, innovation, and pricing power. No single product competitor can match that integrated position. That's the Lollapalooza effect in action. It's really quite something strategically.
It's a powerful model on paper. But you mentioned the customer backlash. What about the human element? If we did a Scuttlebutt simulation, what would we hear from customers, maybe even employees, on the ground?
Ah, yes, the Scuttlebutt. This is where the picture gets, well, a lot messier. And, frankly, quite concerning from a different angle. If you talk to customers, you hear this really split view. On one hand, yes, the tech is good. People respect the performance, the reliability. You see decent reviews on places like Gartner or G2 for the actual products. The stuff works.
Like,
But that respect for the tech is often completely drowned out by a real dislike, sometimes bordering on hatred, of their business practices,
yeah,
especially pricing and how they handled the VMware integration. You look at data like Net Promoter Scores, comparably showed an NPS of Monica 1. That means slightly more detractors than promoters, 44% detractors versus 43% promoters. It's not good. It tells you people are complaining more than recommending.
so they tolerate Broadcom, they don't love them. Like that old saying, captive audience, not captivated audience. What does that feel like for customers?
The VMware situation really poured gasoline on that fire. You hear terms like visceral emotional reaction, wildly insane price increases. The overwhelming feeling from many VMware users is that they feel trapped, exploited. So yeah, the conclusion is pretty stark. Customers are captive, not captivated. They stick around because the switching costs are so high and the tech is critical, but genuine brand loyalty, customer love, seems non-existent.
Okay, that's the customer side. What about employees, especially the VMware folks who came over?
That paints an even more worrying picture, especially for long-term innovation culture. Public forums, places like LinkedIn or Glassdoor, they are filled with negative comments from former VMware employees. You hear about a huge brain drain, talented engineers leaving in droves, a culture of fear, job insecurity, a widespread belief that Broadcom's playbook is just strip mine the asset.
Strip mine, how so?
Aggressive cost cuts, layoffs, focus only on the biggest customers, and basically rinse the current customers who can't move elsewhere for all they got, as one commenter put it. Then, maybe discard the husk. Now, financially, that approach hits short-term synergy targets, but culturally, it's the opposite of what you'd expect from a wonderful company aiming to attract and keep top talent for the long haul. This reported destruction of VMware's culture, that's a significant risk. It could eventually erode the very technological leadership that Moat depends on, something to watch very, very closely.
Wow. So top-tier tech, but customers feel trapped and employees feel discarded. That's a fundamental tension. How does this affect their actual competitive stand against giants like Nvidia or Cisco, who maybe have stronger relationships?
It's a great question. Broadcom operates in brutally competitive markets, no doubt. But its unique structure gives it specific, durable advantages against key rivals. Let's look at the big ones. In AI chips, the main competitor is clearly Nvidia. Nvidia's winning strategy is this complete, tightly integrated proprietary ecosystem. GPUs, their NVLink InfiniBand networking from Mellanox, the CUDA software platform, it's a walled garden.
Okay, closed system from Nvidia.
Right. Then in broader data center networking, you've got the incumbents, Cisco Systems with its huge Salesforce and portfolio, and Arista Networks, which is hyper-focused on high-performance, software-defined networking for big cloud and enterprise customers.
Formidable competitors. So where does Broadcom have the edge, given this unique internal dynamic?
The edge comes from its unique integrated portfolio, combining best-in-class custom silicon and that indispensable infrastructure software. Against NVIDIA, Broadcom's play is customization and open standards. NVIDIA offers a powerful but mostly standardized solution. Broadcom works directly with hyperscalers like Google and Meta to co-design custom AI chips, ASICs, tailored precisely to their workloads. That can offer big TCO advantages.
So bespoke versus off the shelf.
Kind of. And in networking, Broadcom champions Open Ethernet, building a coalition against NVIDIA's proprietary InfiniBand. History often favors open standards long-term. Now, against Cisco and Arista, the advantage is even more fundamental. Broadcom literally makes the core technology. It's the top merchant supplier of the high-performance switch silicon that powers routers and switches from competitors, including Arista.
So they sell components to their rivals.
Exactly. That gives them a built-in edge in tech, performance, cost. Plus, now owning VMware means they control the software layer that manages the whole network. Cisco and Arista don't have that deep integration. Broadcom can offer a more complete hardware-software solution for the modern data center. Rivals can't match that without making a similarly massive, risky acquisition.
Okay, a very powerful, integrated position. But even the best business model needs great leadership. Let's talk about Hock and his management team. What's their philosophy? How did they handle the company's money?
Absolutely critical. And Hock-Tan's leadership at Broadcom has been defined by a very clear, consistent, and I would say relentlessly executed philosophy. It's all about ruthless financial discipline, operational efficiency, and a laser focus on maximizing long-term value per share for shareholders. He operates less like a tech visionary and more like a master capital allocator.
What are his core principles then?
You can boil it down to a few key tenets. First, acquire durable franchises. His M&A isn't about chasing hype. It's about buying mature, market-leading tech businesses with strong moats, critical products, entrenched customers, and predictable cash flow. LSI, Brocade, CA, Symantec, VMware all fit that mold. Second, integrate and optimize ruthlessly. Once they buy something, the playbook is fast and aggressive. Cut costs hard, sell off non-core or low-margin bits, and focus R&D spending only on the most profitable part, serving the biggest customers. Efficiency above all else.
Sounds like a private equity approach almost.
It has similarities. Third, an unwavering focus on free cash flow. Every decision seems geared towards maximizing FCF. That cash is the lifeblood used to pay down debt, fund targeted R&D, and return capital to shareholders. And finally, something I really notice is a high do-say ratio. What Tan says they'll do, they almost always do. That predictability, even if the actions are sometimes jarring, builds huge credibility with investors over time. It's a true owner's mindset, focused on intrinsic value, not quarterly optics.
Very disciplined. So how are they incentivized? Is management's pay tied to this long-term value creation? Do they own a lot of stock?
Yes, the alignment there seems very strong. Executive compensation is heavily weighted towards long-term performance-based equity. Particularly for Hock, they did this interesting front-loaded performance stock unit award in fiscal 23. It's meant to cover his entire long-term incentive for 5 years. And crucially, it only vests if the stock price hits some really ambitious targets over that period, plus he has to stay on board. Because of that, he got no cash bonus for FY24, no annual equity award. His main payday is directly tied to massive long-term shareholder value creation.
That definitely aligns interests.
Absolutely. And yeah, looking at the ownership tables, the exec team and the board hold significant amounts of stock. Personally, they definitely have skin in the game. They win when shareholders win.
So what does this translate to in terms of actual capital allocation decisions? How have they used the company's resources?
The track record is perfectly aligned with that philosophy, and it's been remarkably effective if you look at the results. First, M&A is clearly the primary growth lever. They use capital mainly for these large, transformative, often debt-funded acquisitions of established market leaders. Very disciplined targeting. Second, disciplined shareholder returns. They have a stated policy, return about 50% of the prior year's free cash flow to shareholders. This comes mainly through a really robust, consistently growing dividend, tangible cash back to owners.
They stick to that 50% target.
Pretty closely, yeah. And finally, reinvestment is highly focused. Organic R&D spending is significant in dollar terms, like over $2 billion a year planned just for VMware, but it's strategically targeted. They pour money into extending leadership in their core high-margin franchises. They don't seem to waste money on speculative moonshots. They double down on what works. So if you run this through a rationality test, it passes with flying colors. Capital allocation is rational, disciplined, shareholder-friendly. They have this proven, repeatable playbook. Acquire, optimize, generate cash, pay down debt, reward shareholders. Think about the CA Tech deal. The market was super skeptical at first. Why is a chip company buying mainframe software? But it turned out to be a brilliant move. Diversified the business, massively boosted margins and cash flow. Shows they're willing to make bold, contrarian bets and often see value where others don't.
Okay, this focus on cash flow, disciplined M&A, it sounds like it creates a really strong financial base. Can you describe this financial fortress qualitatively?
It absolutely does. Broadcom's operations and strategy have built a true financial fortress. You see it in several key areas. Their profitability and consistency are just exceptional. Really high, stable gross and operating margins. That's the direct result of leading in these high-value niches with strong pricing power. And adding the high-margin software business just turbocharged that. Their financial engine is way more powerful than most pure-play semiconductor peers.
And how does this show up in the key ratios?
Well, if you look at key quality ratios over the last decade, you see the Broadcom playbook in action. It's cyclical, but the cycle is driven by their acquisitions. They lever up to buy something big. That temporarily hits return metrics like return on invested capital, ROIC, and spikes the debt. You saw ROIC dip sharply after the big deals in 2016, 2019, and now again in 2024 post-VMware.
But it recovers.
That's the key. Between deals, ROIC has often been excellent, over 20%. The track record shows they then use the massive cash flow from the combined entity to aggressively pay down debt and drive ROIC back up. History suggests they'll do the same post-VMware. And speaking of cash flow, their free cash flow, FCF, conversion is incredible, consistently well over 100% of net income. In FY23, for instance, they turned $14.1 billion of net income into $17.6 billion of free cash flow. That's like 125% conversion.
More cash than accounting profit. That's high quality.
Extremely high quality. It means the earnings are real, translating directly into cash for owners. That powerful cash generation fuels everything: acquisitions, debt repayment, dividends, and finally, balance sheet strength. Yes, they take on significant debt for these huge deals. The VMware acquisition added a ton of debt. But again, history shows they use that FCF to deleverage rapidly. Post-VMware, the net debt EBITDA is around 2.5x. That's manageable for a cash machine like Broadcom, and the expectation is they'll pay that down steadily, just like they did before.
Okay, so strong business, seemingly great management, robust financials. Sounds pretty compelling. But the crucial question, what about the price? Even a wonderful company can be a terrible investment if you overpay. What's the valuation picture look like today?
And that's where things get really interesting and maybe a bit concerning. Broadcom's valuation has undergone a massive structural shift. Historically, Broadcom and its predecessor, AVGO, traded like a high-quality but still cyclical semiconductor company, maybe 15x to 25x earnings, depending on the cycle. But starting around 2023, the market completely re-rated the stock. Now it's viewed primarily as a premier AI infrastructure play.
The AI hype train.
Pretty much. And that narrative shift drove a huge expansion in its valuation multiples. The normalized PE shot up from that sub-25x range to consistently over 40x, even 50x. The GAAP PE, with acquisition accounting noise, has even been over 100x at times.
Why the huge jump? Just AI?
The market's logic is that the explosive high-margin growth from their AI chips, the custom ASICs, the networking gear is durable secular growth. So it deserves a valuation similar to other AI darlings like Nvidia. They're pricing it as a secular growth story now, not a cyclical hardware firm with some software tacked on.
Okay, so it's trading at a significant premium. Where does an investor find a margin of safety then? Doesn't sound like it's on sale.
You're absolutely right. Trying to find a traditional Ben Graham margin of safety here, buying at a deep discount to book value or a single-digit PE, that's just not realistic. It probably never will be unless something goes catastrophically wrong. So for Broadcom, the margin of safety has to come from something else. It comes from finding a disconnect between a negative short-term market narrative and the company's long-term resilient earning power.
When might that happen? What kind of scenario?
A few possibilities. One, a market-wide panic. Think 2008 or March 2020. Indiscriminate selling pulls everything down, even great companies. Two, maybe a company-specific but temporary setback. Say, a cyclical downturn hits the smartphone market or enterprise storage segments not driven by AI. If the market wrongly extrapolates that weakness to the whole company, ignoring the AI secular growth, that could create an opportunity. First-level thinking gets scared. Or three, an overblown narrative risk. Maybe regulators make noise about a future deal, or U.S.-China tensions flare up again. If the fear compresses the multiple but doesn't actually damage the core moat or earning power long-term, that could be an entry point for a long-term thinker.
So it still really comes down to the price you pay.
At the end of the day, yes. We've established it's likely a wonderful company by many metrics: moat, management, financials. But like Buffett always says, even a wonderful company is a poor investment if the price is too high. Buying Broadcom at these elevated multiples today implicitly means you're betting on continued very high growth in AI for many years to come. The expectations are baked in.
And if that growth just meets, but doesn't beat, those high expectations,
then the risk of multiple compression is very real. The PE ratio could shrink back towards historical norms. If that happens, you could get mediocre or even negative returns for years, even if the business itself performs reasonably well. Price is the final critical hurdle.
Okay, looking forward then. What are the main engines that will drive growth? And conversely, what are the biggest risks that could permanently damage the business?
The number one growth engine, bar none, is designing and selling custom AI accelerators and the high-speed networking silicon that connects them in hyperscale data centers. This isn't just a cyclical bump, it's a multi-year secular trend driven by massive AI infrastructure spending by Google, Meta, Microsoft, etc. Broadcom's AI-related revenue already exploded up 220% year over year in FY24 to over $12 billion. That's a huge chunk of their semiconductor business now. Management sees the addressable market here hitting maybe $60 to $90 billion by 2027. Huge runway.
Okay, AI hardware is the main driver. What about the permanent risks? What could really break this company?
There are a few big ones. First, customer concentration and the risk of insourcing. A huge chunk of their most profitable revenue comes from Apple and just a handful of cloud giants. The nightmare scenario. One of these key hyperscalers gets good enough at designing its own custom silicon in-house and cuts Broadcom out. That would be a permanent hit to a major high-margin business.
That's a big one. What else?
Second, the risk of strategic failure and long-term moat erosion in software. This goes back to the VMware situation. The aggressive pricing, the forced bundling, it could backfire long-term. If enough customers get angry enough for long enough, it could genuinely accelerate the shift to alternatives like Nutanix or open source over the next 5-10 years. If that VMware moat erodes significantly after they paid $69 billion for it, that's catastrophic for shareholder value.
Harvesting the asset turns into destroying it.
Potentially. And third, there's always geopolitical risk and supply chain disruption. Their Fabless model means they are critically dependent on Taiwan, specifically TSMC, for manufacturing their most advanced chips. A conflict in the Taiwan Strait. A major disruption. That could sever their supply chain. It's a tail risk, but a significant one given the current climate.
Those are definitely major risks to watch. On the flip side, are there any potential catalysts that could unlock more value, maybe things the market isn't fully pricing in yet?
Yeah, beyond just executing on the core AI growth, a couple of things could act as positive catalysts. One would be landing new hyperscale custom AI contracts in the next, say, 1 to 3 years. The market expects success with current partners, but announcing a new major design win, maybe with Amazon, maybe even OpenAI directly, would be huge. It validates the strategy and expands the addressable market beyond current assumptions, likely leading to upward earnings revisions.
Another big anchor tenant for their custom silicon business.
Exactly. Second potential catalyst, accelerated VMware synergies and faster deleveraging over the next few years. They've set aggressive targets for cost savings and growth from VMware. If they beat those targets, the extra free cash flow could let them pay down debt much faster than expected.
And why is that a catalyst?
Faster deleveraging reduces financial risk, boosts EPS directly, and frees up capital sooner for bigger dividend hikes or share buybacks. It's a tangible way to create value faster than the market might be anticipating. It shows the integration is working even better than planned.
Okay, this has been incredibly thorough. Let's try to really sharpen our thinking with some second-level analysis. What's the market consensus missing? Where might the blind spots be?
Right, moving beyond the obvious. The market consensus, the first level thinking, is pretty clear and overwhelmingly bullish right now. It goes something like, Broadcom, premier AI infrastructure play, indispensable tech, VMware adds stable cash flow, flawless execution by Hock, deserves a premium valuation. You see it in all the strong buy ratings. But the contrarian view, the second level thinking, doesn't necessarily dispute the tech quality or the current financial strength. Those are real. Instead, the contrarian argues the market is dramatically underestimating the long-term second-order consequences of management's aggressive business practices, especially regarding VMware.
So the first-level thinker sees the VMware price hikes as proof of strength.
Exactly, proof of pricing power, a strong moat. But the second-level thinker digs deeper and asks, okay, but what is the terminal value of a franchise whose customers feel like prisoners actively plotting their escape? The contrarian view says Broadcom isn't nurturing VMware, it's harvesting a captive customer base. They're maximizing short-term cash flow, possibly torching long-term goodwill and franchise health in the process. By alienating customers so intensely, they're creating a massive incentive for the entire ecosystem, customers, competitors, open source projects, to pour billions over the next decade into finding viable alternatives.
So the market sees the immediate cash, but ignores the potential long-term decay.
That's the core of the second-level argument. The market is correctly pricing the immediate financial benefits of the VMware deal, but it's largely ignoring, or at least heavily discounting, the significant long-term risk that this aggressive strategy erodes the very software moat they paid so much for. That's the key divergence from the consensus view. It's about the time horizon.
That's a really critical distinction. Okay, let's try to synthesize all this. Can we boil it down to a clear investment thesis, the bull case versus the bear case?
Let's try a one-pager summary. The bull case reasons to own Broadcom. 1. Indispensable picks and shovels for AI. They make critical hardware for the AI data center revolution, durable beneficiary of secular spending. 2. Wide and widening economic moat, world-class chip design, intangible assets, plus deeply embedded software with high switching costs, VMware, a powerful combo. 3. Masterful capital allocation. Hock's proven playbook, acquire durable franchises, optimize ruthlessly for cash, return capital via growing dividends, very shareholder-friendly. 4. Financial powerhouse, exceptional margins, massive free cash flow generation, high ROIC potential, resilient business model.
Okay, that's the bull case. Sounds strong. What's the counter argument, the bear case?
The bear case. The counter thesis. 1. Extreme customer concentration. Huge reliance on Apple and a few hyperscalers. Risk if any key customer walks or successfully insources chip design. 2. Harvesting, not nurturing, the software moat. The VMware strategy alienates customers, damages the brand long-term, and actively encourages competition and alternatives. Are they killing the golden goose? 3. High financial leverage. Serial large acquisitions mean substantial debt. Could be a major burden in a downturn or if interest rates stay high. 4. Valuation risk. Current price reflects huge optimism, little room for error, significant risk of multiple compression if growth doesn't exceed very high expectations, leading to poor returns.
That lays out the core tension really well. Now, to really stress test this, let's always invert. Put on the red team hat. What's the absolute most compelling argument for why buying Broadcom today could be a massive long-term mistake?
Okay, the red team challenge. The strongest argument for why this could be a long-term mistake hinges on this. An investment in Broadcom today is fundamentally a bet that you can run a leading technology franchise using a private equity-style operational model perpetually without any negative consequences. And that premise is likely flawed. The bull case calls it a wonderful company. But its actions, particularly towards VMware's customers and employees, the aggressive price hikes, the perceived disregard for relationships are fundamentally not aligned with the long-term stewardship you expect from a truly wonderful, enduring business.
So the argument is that the management style itself is the core risk long-term.
Yes. The red team argument is that Broadcom didn't buy VMware to nurture it. They bought a captive customer list to harvest it. The radical product changes, ending partner programs, the shocking price increases. These aren't moves to strengthen a franchise. These are the moves of someone cashing a winning lottery ticket, monetizing those high switching costs built by previous management as fast and hard as possible.
It sounds brutal when you put it that way.
It's the red team view. Now, this harvesting strategy will likely look financially successful for the next, say, 3 to 5 years. The moat is strong enough that customers can't flee quickly. The numbers will probably look great, but over a 10 or 20-year horizon, this approach is arguably value destructive. It galvanizes CIOs, architects, developers against VMware. It fuels billions in investment into competitors like Nutanix, into open source alternatives. It creates an army of motivated people looking for an escape route.
So the long-term mistake is misreading the short-term results.
Precisely. Misinterpreting short-term financial success derived from harvesting as evidence of a genuinely widening sustainable moat. When or if that VMware software moat finally cracks under the pressure of customer animosity and newly viable alternatives, the market will eventually reevaluate Broadcom. They'll realize a big chunk of those stable, recurring software earnings are actually in long-term decline. And at that point, the stock likely gets re-rated. The premium AI software multiple gets stripped away. An investor buying at today's valuation could face a permanent loss of capital as it gets repriced, more like a highly leveraged, cyclical semiconductor company. The decision to harvest VMware, rather than nurture it, could be the strategic blunder that ultimately torpedoes the long-term investment case from today's prices.
Wow. That was a truly deep dive into Broadcom. We've seen the incredible strengths, the powerful business model, the disciplined management, but also critically, those significant long-term risks and tensions that the market's current enthusiasm might be glossing over.
It really boils down to that central tension, doesn't it? The undeniable short-term financial power and operational prowess versus the potential long-term fallout from strategic choices that seem to prioritize extraction over, let's say, sustainable partnership.
Exactly. So for you, our listener, here's a provocative thought to chew on. Is a company that maximizes its current leverage over customers truly building an enduring fortress for the next few decades? Or is it just giving everyone else a massive incentive to find alternatives, accelerating the eventual search for an exit? If you were running VMware today, focused on the next 20 years, what strategic path would you choose? Something to think about. Let us know your thoughts in the comments, what really stands out to you from today's deep dive. Thank you so much for joining us on this exploration. We look forward to diving deep with you again next time.